Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Wanted to come to you today with a little bit of a soapbox rant, if you will. Occasionally I get angry or grumpy about things, so I will put on my Oscar the Grouch costume today. Because I recently, noticed that Vanguard, it's made sort of splashes in the industry. Vanguard has come out and basically said, hey, the 60-40 shouldn't be the 60-40 anymore. It should be more like the 40-60. And there are two things that I kind of hate about pieces like this. And I understand why people do them. Right? And the reason why people do them is to attract attention, to attract headlines. It's a thought piece. It gets people reading, gets people interested, and Vanguard ultimately makes money off that. And I understand why they feel the need to publish those things. But no matter how good intentioned the author maybe is in terms of, trying to, educate people on this, there are two things that I kind of hate about it. And the first is it lends credence to this concept of you should be trying to time the market by moving aggressively into or out of equities, into fixed income, out of fixed income. You're talking about a pretty massive reduction in the overall equity portfolio for your average client, a pretty massive increase on a percentage basis of the fixed income portfolio of that client. The second thing that I hate about this is that if you get into the nuts and bolts of the argument, it really suggests that markets behave in a way that we know that they don't. The gist of the argument is that the S&P 500 is at very, very high valuations. The stock market itself is at very, very high valuations. S&P 500 trading right now at about 22 times forward earnings, which is admittedly high relative to its history. If you look at something like the cyclically adjusted PE or CAPE ratio, it would tell you that we are very high, et cetera. And so, the author is looking at this and saying like, okay, well, when the market's at these sort of high valuation levels, your average return over the next 10 years is historically a little bit lower than it would be if we were at lower valuation levels. That intuitively makes sense to me. I get it. I understand what you're suggesting. However, it makes it seem to the average investor that markets trade off just because they're highly valued. And that is emphatically not the case, okay? Markets trade off because there's a negative catalyst somewhere, right? Like when we get big sell-offs in the market, it's due to some sort of surprise arising, that shocks the market in a way that changes expectations of the future and causes people to get scared and sell off, okay? And those surprises, shocks, 2025 is a perfect example of this. We entered 2025 trading at 22 times forward earnings. And by the way, the wailing and gnashing of teeth about how highly valued the market is was prevalent back in early 2025. And then in April, we got a catalyst around tariffs and the market sold off by about 20%, right? Not because we entered the year high, but because there was a catalyst, right? And then that catalyst appeared short-lived. The administration kind of backed off. Tariffs weren't as big of a deal. And we're ending the year trading at 22 times forward earnings. And through that time period, the S&P 500 returned 17.9%, right? So this notion that, and you can go back and look at any other time period where the market has sold off, it's almost always driven by a recession that comes up, or a virus, or a bubble that pops and collapses. Greenspan called the internet bubble back in 1996, 4 years before it actually started to sell off. And so my second problem with this argument is it doesn't accurately portray the way in which markets sell off when they are highly valued. Just because something is highly valued doesn't mean that it's going to sell off tomorrow. Mean reversion doesn't happen by chance. You need a catalyst in order for the market to start to move lower. And that's one of the reasons why I get very frustrated with these types of arguments, because back to the first point, let's say you do sell off, right? Like let's say you do rotate your portfolio and sell a whole bunch of equities, and then we get another 2025, right? You're likely to convince yourself, because this is the way that investor behavior works, that like, oh, well, Vanguard was wrong and I missed out on a close to 18% return year, so now I should go back to 60-40. Because, oh, by the way, I was willing to move to 40-60 in the first place. So apparently, I don't have a firm guide rail as to what my portfolio should be. I'm allowed to move it around however I see fit. And we just saw that the 40-60 don't work. So now I'm going to, get more aggressive with my portfolio. And that type of market timing, precisely back to the first point, really never works. So for a whole lot of reasons, I will get off my soapbox now. I appreciate you guys tuning in, but it really does drive me nuts when I see what I can only assume are well-intentioned people publish these types of reports, because ultimately it only hurts you when you pay attention to that stuff. It doesn't help you. With that, as always, if you have any questions about this, please feel free to reach out to me or to your advisor. I hope you're having a fantastic day, and I look forward to talking to you again soon.